Good afternoon and welcome to the first of our webinars on the corporate governance reforms. This is a brief introduction to the reforms now that the consultation period has closed on the 8th of July. My name is Jeremy James. I'm the founder and managing partner of Ownet. We are a consultancy with a unique, high-value, low-cost, client-centered model, helping clients to deliver transformation and assurance projects. I have with me today my co-presenter, Jano Sathavasatham, and he's one of our experienced GRC consultants. The session today should last no more than an hour, and there'll be time for Q&A at the end of the presentation period. So please can you add any questions into the Q&A, which you'll find, I think, at the bottom of your screen. And as we go along at the end of the webinar, we will endeavour to answer all of those. So today our focus is going to be on why these reforms have come in place, what those proposed reforms look like, and what the impacts and accountability and scope is for the firms that are involved in the and subject to this new proposed regulation. And then we will take you through some of the lessons learned and what you should be thinking about doing now to be ready for when the final regulation comes into force. And as I said, we will then have time for questions and answers at the end. So the reason for the reforms really being pushed at this point in time comes down to a lot of recent corporate scandals. A lot of these are focused on either large private organizations or listed organizations that have either failed due to accounting issues, due to fraud, due to lack of audit oversight, and some of them have been overstatements. So many different reasons that have caused issues that have weakened investor confidence and also the confidence of public in well-known names within the marketplace. This isn't something new, though. We could go back to 1992 with the Cadbury report when the combined code was introduced due to the same concerns over the ability for companies to be able to ensure that they have integrity over their financial controls and their reporting. And this history has gone all the way through from the Turnbull report in 99, where it looked at really how you could, and what needed to be done from a managing risk perspective, and the idea that was brought forward through the combined code of comply or explain. And then you had the big scandals in the US that resulted in the Sarbanes-Oxley Act. And not only did this affect global organizations such as the Enrons, the WorldComs, the Tycos who failed, but it also affected large audit firms. It saw the failure of Arthur Andersen due to all of these scandals, and therefore the Sarbanes-Oxley Act was brought into place. And over the years, we've had guidance coming through on the combined code from the FRC, the Financial Reporting Council here. We've obviously seen in other jurisdictions such as Japan, who brought in the Financial Instruments and Exchange Act, sometimes known as JSOX. And now this is the latest in us as a market trying to restore trust in audit and corporate governance. And there are a lot of similarities to what has gone on in past, but it is not identical to any of the acts such as SOX or JSOX that have gone before. But it does definitely have lessons learnt and some of the structures that they have implemented there. So at a high level, the proposed reforms really have three key aspects to them. They want to improve the audit market. This is to break up the dominance of the big four audit firms, increase competition so that you can have smaller challenger firms or some of the mid firms starting to be part of the audits of larger organizations. And larger organizations will be required to bring in a non-big four firm to take on a part of their audits. And there is a caveat to how this will improve the audit market by saying that if there isn't an improvement in the share of the market through the audit firms, that they will introduce a cap on the market share of the big four for FTSE 350 organizations. The second part is about reinforcing investor and public confidence in audit. So these proposals are focused on all listed and large private firms within the UK. It's going to introduce new reporting obligations on both the auditors and the directors around detecting and preventing fraud. So what this will mean is that the boards will have to attest to what controls they have in place, what frameworks they've put in place to ensure that they have understanding of their risks, they have controls over those risks, and they're able to have transparency over their financial reporting, as well as non-financial reporting elements as well. And the auditors will also have a responsibility to identify issues and trends that may point to improper accounting and potentially insufficient disclosure. Now, to ensure that this is driven and put in place, a new regulator will be put in place called the Audit Reporting and Governance Authority. This will take over from the FRC, and it will have increased powers to be able to bring sanctions without having to revert to the courts, and will be the regulator over the new corporate governance reforms. And the whole purpose of putting this in place is to strengthen the UK's position as a world-class destination for investors, but also improve public confidence through, on the back of a lot of the scandals that I mentioned earlier. So going into a little bit more detail, a lot of the accountabilities are going to fall on the board of directors of these organizations. And it's very much focused on the accountability for the internal controls over the financial reporting and some other non-financial information. So non-listed businesses will be included in these reforms, which is different to what you had within Sarbanes-Oxley. So the scope of these reforms are very pervasive. And those non-listed firms, the directors will have to determine whether they fall into scope. For all firms in scope, the boards will need to set clear ownership and structures of their frameworks over the internal controls and make sure that those are sustainable and developed. And Jono later will go through some of that scope and some of the structures that you can put in place to facilitate an embedded and sustainable compliance framework. The board of directors will also have to acknowledge and report on how they've established and maintained an adequate control structure and what processes and procedures they've put in place for their reporting. And this will also entail an annual review of the effectiveness of internal controls over the financial reporting and over some of the non-financial information, as mentioned before. And within this, they will need to lay out how they have gone about making their assessments. They need to report on any material deficiencies in their control systems and also report what associated remedial actions are being put in place. And as said, this is about creating transparency and creating confidence in the market. So they will then need to be able to make a statement on whether they consider that their systems have operated effectively. And one last element that is in place is that there has been, for a number of years, guidance and self-regulation over the payment terms for especially SMEs. And this will be part of the reporting requirements and the practices going forward. And all of these will be connected back to the board of directors and will be linked to their remuneration. So performance indicators and anti-fraud arrangements will need to be put in place as well. So when we start looking at what the scope and degree of assurance looks like, the governance, the first port of call really for thinking about what needs to be put in place and what fundamental stages you need to look at is to really make an assessment of what your current state is. If you are already under SOX obligations or JSOX obligations as examples, you will probably be a lot more mature in where you are. But as I said before, these are not identical regulations. So there will still be work required to tweak the processes you have in place and to potentially do some different analysis on materiality on your risk assessments. You'll then need to design and start to document your processes, understand those risks, document those, and pull your controls matrices together, building that compliance framework. And then obviously implementing that to ensure that you can carry out testing, carry out effectiveness reviews, understand where the deficiencies are, put in place remedial actions, and then there will be an ongoing loop of improvement. Now, a very good place to start with designing these frameworks, if you haven't already got something in place, is to have a look at the COSO framework, and the cube here is a pictorial of what that entails, and from an IT perspective, COBIT 2019. So those are good starting places for your control frameworks that you can start to put in place. Many GRC tools that are out in the marketplace today have obviously taken lessons learned from the past, and Jana will go into this in more detail, but they will have frameworks that you can use to configure as well. So a very good way of accelerating your capability is to look at those GRC frameworks, and this will also help with sustainability and maintaining the frameworks going forward. So just to wrap up on that, the management teams are going to have to take responsibility and work through a number of critical areas to ensure that they can meet this regulation. And that's going to entail a lot of project governance, putting structures in place that enable them to develop effective governance arrangements, being able to assess where, as an organization, your culture is related to risk and control, and what that appetite of risk and control is to your organization. And finally, as mentioned previously, looking at implementing a GRC tool that can help unify all of the information related to your processes, the risks and the controls associated to those, so that all of your organization can report up through your framework so that the directors can make the right assertions as required. So I'm now going to hand over to Jano, who will take you through the timing and the companies impacted on this as well. So Jano.
Thank you, Jeremy, and a very warm afternoon to all of you. I will now speak about the companies impacted. So who should these reform proposals apply to? It should apply to the current public interest entities, which are the listed companies. So this would be the premium listed companies comprising the FTSE 100 and the FTSE 250, collectively the FTSE 350 companies during the initial period, and then extended to the large private companies such as important corporations and utilities, for example, and to the larger AIM listed companies after 2 years. All of these companies should prepare themselves by staying ahead of the upcoming reforms. The private companies. Government proposes to extend the UK's PIE definition to include large companies within certain limits, regardless of whether they are admitted to trading on a regulated market. Two options have been put forward. Option 1, adopting the test used to identify those large companies which are already required to include a corporate governance statement in their director's report. That is, all companies with either more than 2,000 employees or a turnover of more than 200 million and a balance sheet value of more than 2 billion. Option 2, a narrower test which incorporates the threshold for additional non-financial reporting requirements for existing PIEs, and would mean the definition of a PIE was only extended to large companies with both over 500 employees and a turnover of more than 500 million. This, it is estimated that option 1 would mean that approximately 2,000 entities would be brought within the definition of a public interest entity, whereas option 2 would mean around 1,000 additional entities being caught up by this definition. AIM-listed companies. The government intends that any new definition of PIE should also include companies on the exchange-regulated AIM market, which is the alternative market, with a market capitalization above 200 million. And for newly listed companies, the government is considering whether to make the transition to listed status either by making compliance with some or all of the proposed new PIE requirements optional for a period of time after flotation, subject to gross revenues remaining below a specified threshold. The final regulations may be different to these options or be one or more combinations of these options. As Jeremy mentioned earlier, we just closed the consultation on the 8th of July. So we are a little ahead of the curve. Here is a snapshot of the expanded list of PIEs going into some of these other type of entities which may not necessarily be listed. Let us now look at the lessons learned and what we should start doing. As described earlier by Jeremy, the Sarbanes-Oxley Act was introduced after the catastrophic corporate failures and scandals in the US. It was to strengthen the internal controls over financial reporting and make the senior officers of the companies accountable, and to establish internal controls and procedures, and to document, test, and maintain these internal controls and procedures to ensure their continued effectiveness. The lessons learned. In the past, when SOX, for example, started, there was not much time spent on planning or building a proper framework. A large number of controls were identified with a poor understanding of the material financial impact of the control failing. Even a process was written as a control in many instances. This created heavy burdens on the finance team and the controls team to test, remediate, and constantly keep on top of all these controls. Soon, management began to rely more on entity-level controls and redefine controls to key controls, wasting so much time and effort they had spent at the early stages. People were also using a multitude of applications like Word, Visio, and PowerPoint to draw up the flowcharts. Process and controls documentation was recorded in Word, in Excel, standalone applications, and shared drives, resulting in a lot of cut and paste, duplication, transmission errors, and manual updates to each documentation. So what should we do now? We really need to take off. We have sufficient knowledge from ongoing control procedures. We may know the areas of greater concern in our organizations. We should now rethink our objectives, risks, materiality, so forth, so we can improve planning, allocate resources, and set timeframes and milestones. Use SMEs, the subject matter experts, where needed, and suitable and robust GRC tools to run the compliance project. The areas to focus: strengthen the culture of controls, transparency of management and staff, provide company-wide guidance, training, and the motivation to do the correct things, automate controls where possible, and streamline the internal controls framework to be managed efficiently and effectively. The proposals are going wide enough to suggest that high payouts to directors in terms of bonuses should even be clawed back if there are corporate failings. Also work with third-party service providers to ensure their controls are also in place as adequate as you need it to be. Let us now reflect and summarize. Internal control failures still happen. Therefore, we should establish an effective internal controls framework. Directors need to be made more accountable, and we must adopt suitable GRC tools to improve efficiencies and oversight. The benefits of early implementation of a GRC framework is better planning to achieve desired objectives and timescales, efficient resource utilization for better value of staff and meeting your budget, and most importantly, effective internal controls framework to become compliant. I'll now pass you on to Jeremy. Thank you.
So thanks, Jano, for that and for summarising. So we now want to really focus the rest of the session on any questions and answers that you may have. As I said earlier, this is a brief introduction. The consultation has just closed. We do not expect to see outcome from that consultation for a number of months, and it will then have to go through Parliament, and it will be interesting to see how that is managed, whether there will be a different legislation for setting up ARGA, also a separate legislation for improving the audit market, and then a separate one for the internal controls reporting and oversight. As that is probably one of the easier legislations to take through than obviously the audit market itself, which will have a lot of different impacts on the firms involved. So I've got a question through now. So please do add your questions as we go through this. The first question is, so listening to all this, should we be looking to set up a new controls function or redefine our internal audit function? So I'll take this. So basically, the internal controls should be managed by the financial control team or the teams that are managing those non-financial processes that need to be reported on. There are, though, then choices on how you decide to manage your control function that sits above that. So looking at the risk assessments, the materiality, the scoping, the testing of the design of the control environment, the effectiveness of those controls. Some organizations may go with self-testing. So this is people in the line doing their self-testing and then assertions being made through management up to the board of the basis of that. Other organizations may decide to have a separate internal controls function. This could sit within finance, alongside finance, with a reporting into the audit committee. And they could be given the responsibilities of the test, the design, effectiveness, looking at the scoping, ensuring those assertions. And other organizations will use the internal audit function to do this as well. Now, what's important is to ensure that you look at the full control environment to ensure that when you are deciding on the responsibilities and accountabilities of the corporate reforms here, that you're not leaving gaps in your overall control framework through the organization itself. So I hope that answers that question. A second question that's come through is, we are not a SOX regulated firm, and up to now haven't got anything in place. So this is all new to us. How should we get prepared to start this project? And John, do you want to take a...
Yes, yeah, sure. Yes, a good question. For companies who have not really gone ahead with such a compliance project before, what they need to do initially is set up the internal controls compliance project. So the project has to be set up to build the framework. Then you can start building your framework. You start with performing your risk management. So build a risk register and define your materiality. Look at any past incidents that can be good starting points of accounting and disclosure weaknesses. This could be from some other, either some internal or external audit or some special projects that were carried out. Look at any past incidents of accounting and disclosure weaknesses. That's what I was saying. And then review findings identified by any internal audit or external audit partners. You can also benchmark if you have a benchmark statistics with similar companies. There are some studies that have been carried out, or your SMEs obviously can give you experience of these sort of risk matrices. A lot of the GRC tools also nowadays come with a sort of standard set of risks which you can use in order to start getting prepared. So I hope that answers the question. Anything to add, Jeremy?
No, I think you know, a lot of this is about setting up the program, making sure that you have the tone at the top of the organization ready to be able to understand what their responsibilities are going to be as directors, so that this gets the the required visibility and momentum behind it, so that they can drive what will be a lot of work.
Mm-hmm.
When the if we go back to setting up of SOX frameworks, and as Jono said, people went over the top, and every single item was looked to be controlled, regardless of whether there was a risk there or a materiality there to that risk. But there is still going to be a lot of work to understand your processes, where those risks are, what the materiality is. And the sooner you start thinking about this, the better placed you will be. There are a lot of the lessons learned, and as Jono said, when the GRC tools now are a lot more mature than they were 20 years ago, obviously, and there is a lot of configuration that can be done within those tools to ensure that you have a sensible number of controls for the size and type and complexity of your business. So I would very much encourage people to leverage what has been done before. So another question, there's some similarities to the first question, but how similar or different is this compliance project to internal audit and risk management? Johnny, do you have anything to add from what I said from the first question?
Yes. So internal audit looks at the end-to-end process and how these are functioning within an entity in line with the policies and practices adopted within the business, along with, say, fraud detection. And fraud detection in internal audit has been more in terms of embezzlement, things like false payrolls and duplicated payments and things like that. So the general fraud by perhaps members of the team, etc. And risk management looks more at operational risk, such as crisis management and specific compliance, such as health and safety or bribery, anti-bribery, anti-money laundering, etc. So for these reforms, which we are talking about now, the core focus is on internal controls over the financial reporting and non-financial metrics. So we would be looking to focus on specific controls designed to prevent or detect practices that lead to financial statement errors and improper disclosures, and on areas such as dividends and director payouts. So that is, I guess, the main difference between your normal internal audit and risk management process.
Yeah, and I think to add to that, coming back to what I said earlier, that these reforms are there to improve investor confidence and public confidence in the UK market. Mm-hmm. And hence it's all about the reporting of the financial statements and the statements that are being made about non-financial key indicators of that business, so that investors can make informed decisions and the public can be confident that, as an example, the pension pot is is safe and being managed correctly. So that I would say is where the focus when thinking about what is the end goal of this. It isn't, at the minutiae level of, has someone signed this piece of paper? It's, has there been an issue that could affect the reporting of that organization out to the wider stakeholders?
Indeed, Jeremy, yes, because this is where the problem arose, where companies, were seen to be giving what you call clean reports with no alarm bells ringing. and then within 6 months, you see the firm, collapsing because of grave improper reporting errors, etc. Yes, so this is to kind of try and prevent all that happening. Yes.
So another question that we have is, which factors should we consider when thinking about setting materiality levels? And do we need a set of levels for different areas of our business? Jana, do you want to go on?
Yes. So as I told before, I think there was a question on how we start this sort of compliance framework. And I mentioned that materiality levels need to be set up. So this question is a good follow-up. Materiality levels are very important because that gives a perception of what we are trying to get at. A large company obviously will not be impacted by sort of issues relating to a smaller financial amount, so depending on the profit and loss, the total revenues the company earns, the profit it makes, and then the size of its balance sheet. So you could look at different accounts in the balance sheet and you could evaluate the sort of size value of them, and then set upon your materiality, which is generally, say, a percentage of gross turnover, etc. You can also, for balance sheet items, set different materialities for different groups or clusters of balance sheet accounts. And again, if you're a group of companies, you might wish to set different materiality levels for your subsidiaries and then kind of have an overall higher threshold for the consolidation purposes. So yeah, I think that's what materiality levels helps with.
Yeah, and I think to add a little bit to that as well, when looking at the balance sheet accounts, it's not just the value within that balance sheet account. It is also about the number of transactions through that account, the size and value of those transactions as well. And again, if you are a group company, as Jana mentioned, there will be different environmental factors that come into where you place your materiality. So if you have higher risk levels in a certain environment, you will potentially have a different materiality to that. And within this is also looking at what is the aggregate of the potential issues that you have within your organization as well. So there's a lot to take into account while doing that assessment, and also looking at what the sort of frequency of those types of issues occurring as well. Sure. So another one, this is a very practical question. So how best should we start our process documentation and controls identification? So as I again said earlier, it's, this is about setting the project in place, setting the governance, getting the tone at the top so that you can drive this change. And for many firms, this will be a big cultural change, not just a tick box exercise. So once you've got the project framework in place, it's then looking at how do we set up the framework? How do we ensure we have the structures in place to be able to inform the board of the compliance and effectiveness of those internal controls so that they can report on that effectiveness, and looking at how do you make this sustainable. So all of this is really done before you get into the nitty-gritty of process documentation and your identification of your controls. And what I would say is definitely leverage the lessons from the past. We've said it a couple of times, there are some great GRC tools out there that come preloaded with processes, related risks, the control objectives, the key controls that are related to that, so that you can configure those to your business, and making sure that you really do understand at what level you need those controls. There will be a lot of documentation involved in these, because you are having to look at, who is doing the control, what is the control, how is that control being carried out, the frequency of that control. And you're also then starting to look at the remediation and whether you need to put in place new controls, or you need to strengthen existing controls that are in place. And that is where the governance comes very much into this, because that's where you can run down rabbit holes and create, ineffective or inefficient control structures within your organization. So making sure that the design of your controls is very clear, understanding what the objective of those controls are and how that is mitigating the risk and to what extent becomes absolutely critical. There's no getting away from this, that this is a lot of work. We do not at this stage know when the date of application will be. There are, some people are talking around, 23, it could be later, but again, a lot of this will be driven by the legislation going through Parliament as well, and how quickly that can happen. So, getting ready for this, it's worthwhile doing that groundwork now. This is going to happen. It's about the timing and making sure that you get that project in place so that you can start to document. And you can use, obviously, documentation that you've got from different areas of the business. And this is where one of the benefits of this type of legislation comes in. It is actually a very good housekeeping exercise to bring information together in a coherent manner that will add benefits not just to this regulation, but to the efficiency of an organization. It will look at your reputational risk, brand risk within the marketplace as well. John, anything to add on that?
Yes, I think not much to add, but just that it is an iterative process. So as you start doing your controls, your risk, as you start testing, as you start identifying the gaps, yes, you will then start improving, retuning, and maybe changing some of the controls, changing or even descoping something and bringing some other areas into scope. So it's an ongoing exercise, which once you start, you will have a better understanding of, and then you can keep fine-tuning it.
Yeah. The next question, and we've mentioned these quite a bit, talks about GRC tools. It says, you spoke about GRC tools that can help us. Which are the good tools we could look at, and will this be costly? There are several strong GRC tools out there in the marketplace. These tools, as I said before, have really matured. They will accelerate being able to implement the required structures. They will ensure sustainability and help facilitate embedding internal controls, reporting into an organization. This is an area that, as Ownet, we can very much help you with. The type of tool that is right for your organization will differ depending on the complexity, the size of your organization, the structures and your ambitions within using this regulation to truly create a process and control and risk culture within the business. And that is very new to a lot of firms that haven't been under this type of regulation for years. So I would definitely, encourage you to, talk to the likes of ourselves about different tools that are out there, and we can help you with that analysis. Fundamentally, though, what I would say is that the amount of work and complexity when going through these, if you do not use a GRC tool and you go down the, Excel route for your test plans, for mapping all of your control framework, creating process maps and documentation in Word or PowerPoint, etc., it becomes unwieldy, complex, and inefficient. The value you will get from a GRC tool will outweigh the cost of the implementation and the ongoing subscription or purchase of those licenses. So that business case can be pulled together, and again, that's something that we are adept at being able to help with. So please do shout, because I think it would be wrong to pinpoint specific tools at this point, to say this is better than this one. There, as I said, there are a number of great tools out there, and it's what will fit to your requirements. So I've got one more question. So if there are any more questions from anyone, please do add them to the Q&A. And this one, I suppose, slightly interesting. It comes from a different angle. It doesn't look like we are going to be in scope for these reforms. How should we set up a project to improve our internal controls and automate some of our processes and controls? So I don't know, Jana, do you want to take it? This is obviously someone who's listening who, thought they might be what you've said about the scope.
Sure.
It looks like they might.
Yeah, and maybe they may not be the initial set, but they could always, be considered later depending on how the government moves with this. But in any case, if you want to be an entity which is socially responsible and which wants to, keep the trust of all the stakeholders that you're dealing with, you would still want to take on a project to strengthen your internal controls. The setup would be quite similar, but it would not be, you will have more flexibility, and you will be able to report on how you report the structures and put everything in place. It is always best practice, as I said, to strengthen internal controls and avoid costly financial misstatements. Even in terms of resilience, there's also been things like the operational resilience going on in the market. So for a company to be more resilient and to even help its operations, the financial compliance should be working well. So you don't want to be distracted by an accounting error, a tax error, or something coming right through the middle of the year when you're trying to really improve your operations, when you're trying to grow your company, etc. So I think it's a very good thing to go ahead and do your compliance framework, strengthen your internal controls. The last thing you would want is to lose the confidence of even your staff. Your good staff can start to leave. Creditors, lenders, what happens if there's even a small error in financial statements now, people get nervous because of what they have seen. They've seen audit reports glorifying a company, and shareholders have been pumping money into these companies, and then it has collapsed. So even if you're a smaller company and you start having any irregularities or having to restate your financial statements in a later year, you're going to start losing that trust that you built up. And you don't want to be distracted by that when you're trying to grow, you're coming out of a pandemic. So I think it is a good idea for you to still go ahead. And you may be lucky because you don't have to go on a stringent basis, but you can go at your own pace. But start early, because I think you need to have something sooner rather than later. What do you think, Jeremy?
I agree. I think, having, and I hope everyone can hear me, my screen went blank while Jono was talking. So can you hear me, Jono?
Yes, I can hear you now.
So absolutely, I think, there's always a place to ensure that you have good management of your financial controls, how you report those, whether that be to private investors, whether it be to an owner of the organization, a board, and how that is reported up, and to ensure that that's in place. And if you're a fast growing organization, that is where risks start to manifest themselves. So if you are an organization that is looking to grow now and going forward, I would very much encourage putting those structures in place now rather than waiting until the issues manifest themselves. It's always easier to do it in a controlled environment than a environment that is out of normal working practices.
Mm-hmm. Yes, so, and if I was to add one more item also, if you ever want to, or you're thinking of doing an IPO, for example, you need to have all these controls in place very stringently, whether you're going to do it in the UK or overseas, like the US market. So having it in place is going to help you even at a later stage if you ever think of, going that route.
Fantastic. So I haven't got any more questions coming through on the Q&A at this point. So we're just sort of about 7 minutes before the hour. So I think probably a good time to wrap up, unless you've got any last comments or on those questions, Jono.
No, I'm fine. I hope everybody has found this very useful.
So all it then leaves.
Hello, everybody. If you're still there, I think Jeremy has got cut off. So if you can hear me, thank you very much for attending our webinar on the proposed reforms on corporate governance and internal audit. And please reach out to us if you have any questions. Thank you.